Welcome to another edition of Zacks Rank Buy. I am Brian Boland. I'm the aggressive growth stock strategist here at Zacks Investment Research, and I've got two more stocks for your aggressive growth radar screen. All right, normally I don't talk about financials because they're not really growing. They're not huge. They're not they're not doing it for me. But I did find a couple that I think will be interesting. So let's go to our first one. And what do we got? We've got Robinhood. Robinhood Markets, as you know, that is the app on your phone or computer that lets you trade stocks for free, so to speak. HOOD is the ticker. It's a Zacks rank number one. That's a strong buy. A B for growth and an F for value. So I like a strong growth score and a weak value score that tells me right away I'm on the right path here. And we can see that it's got a $31 billion valuation. Now, they beat earnings, the stock shot up, but the whole market in turmoil has really sent this thing down. We're looking at nearly a 50% decrease. The idea is that Robinhood is selling your trade data information. So when you're trading, it's going to let the other people know for volume that they want the volume. They're going to send it to them. They get paid from them. That's how they make their money on the trades. Little fishy stuff happened back in the day with the GameStop and AMC craziness where they didn't allow you to buy it. They only allowed you to sell it. That was kind of ugly, but I think the market has moved on a little bit from that idea. All right. Are you beating the number? Well, the last year we see three beats and a miss, right? So, but 18 cents, 21 cents, 17 cents, and then really lift off here in this most recent report, 54 cents versus 42, 28% beat. I like it. It's not the cleanest look, but it's not the worst either. All right. How about our estimates? We're going from 23 cents up to 36 cents. That is a big move. 25 cents to 35 cents. Another nice move. And you see it right here in the full year, $1.09 to $1.51. I'm not good at math, but that's really close to a 43% move in estimates for this year. And then $1.37 to $1.73 next year. Why don't we cheat a little and go up here and take a look at what we love to see? This is all about growth. This year, the company is going to make $3.7 billion. Make. When I say make, I mean they're going to bring in $3.7 billion in revenue. That's good for 25% growth. That's outstanding. Next year, they're going to go up to $4.24 billion. That's good for 14.5% growth. So good growth on a good base, on a good size company. So what are we paying for this kind of growth? Well, we're going to pay 23 times forward earnings. But if you look at this number, boy, that's 115% top line growth over last year. I would take it. That's good to me. I would think you would be at almost 40 times, 50 times your forward earnings if you're going to grow that big. All right, we've got a 3.95 times book, which is good to see. Value investors mostly interested in stocks below 3 times book, but this one was an asset slim model looking good there. So that's why it's going to have a little bit more elevated PE. Price to sales kicking in at 10.7. Here's your story. Operating margins, 13% to 21% to 33%. Big growth in margins coupled with revenue growth gets you bigger EPS. And we can see how that's done for the stock here. Now, right about here, I think you got a lot of that GameStop nonsense out of it. I think the GameStop was back, that was, I don't even know. Doesn't matter. All right, trading around $10 and kind of left for dead. But all of a sudden, hey, people are back interested in this market, especially right around here, the election. They pretty much kitchen sink that quarter, put in all your bad news. It doesn't really matter because stock's going, Bitcoin's back, that sort of thing. So they're trading crypto there. So we run up and then markets in turmoil at the start of this year. So back down. I think this is a great opportunity to take a deeper look at Robinhood, HOOD. All right. So that's a big boy. Let's go take a look at a small player in the financial world. This is Opportun Financial. OPRT is the ticker. It's a Zacks rank number one. That's a strong buy. It's a B for growth and an A for value. Now, normally I like to see a weaker value score, but the valuation here is compelling to me on this one. So we can see this is only a $214 million market cap company. So that's pretty small in comparison to 31 billion for. So what they do, they do small loans. It's like $300 to 10 grand, something like that. And they use AI to figure out if you're going to pay back your loan. As we know, most people do want to pay back their loan, especially in that sort of situation. All right, we got beats here. This is technically a 200% beat because they were looking for break even. They got two sets, 300% beat, and big EPS here. We're earning money every quarter. That's great to see on a small name like this. What are estimates doing? Well, there's a little herky jerky here. We've got I'm going to give this a down arrow there. For the first quarter, estimates come in. That could be management just talking them down. But next quarter, moving higher for the full year, which is more important than any quarterly estimate. We would go from 103 to 118, so about 13% growth there. And then next year, 158 to 167. That's interesting. It got a B for growth, but I cheated a little bit. I looked ahead. And I see that 963 million in revenue, that's going to be revenue contraction. Never see that. We never like that in aggressive growth. But we know next year it's going to pick up. And here's the idea. Lower rates, if they're coming, should be good for a company like this. That means they're going to generate more loans because people will want more loans when the money is cheaper. The valuation here is the story, though. 5 times forward earnings. I mean, that is a clear on value play. Price to book at 0.6%. What that means is you're buying the company for at a 40% discount to all the assets on the books. So that is a value investor loves to see that. Price to sales is pretty low because we're loaning out probably other people's money. We didn't have good loan growth, but fees and things like that help. And that's what's turned operating margin from the negative 4.2 to 2.4 to almost 2% on a plus side. So margins growing, potential for rate decreases coming. So that could drive the business a little bit more. And, you have potential for a small name to find some real excitement here. Now, this stock was $25 back in 21. The tech wreck really ate this one alive. 25 down to 5, hanging out for quite a while, but just starting to move up. And it looks like it wants to test that $10 range. I think that would be your next stop. But for the stock sitting here at $6, to move up $4, that would be a gigantic move. But I think that there's something like that in the future for it because we could see the earnings estimates continue to move up. And if he gets a little support from the broader market, things should be good. Okay, it's OPRT. Well, that's it for this week. Be sure to join me next week when I've got 2 more stocks for your aggressive growth stock radar. But until then, why don't you go to Zacks.com/promo to check out all of our latest promotions.